The move by the central bank to reduce the benchmark rate in its latest review will indeed be welcomed news by many borrowers who are seeking to get affordable loans. The bank's Monetary Policy Committee MPC has lowered its indicative interest rate by 100 basis points to 8.5%. In a statement sent to newsrooms after its meeting, the committee attributed the move to stability in key indicators. The MPC says the current rate of inflation has remained within the government's medium-term target of less than 5%. The exchange rate has also remained stable and strengthened marginally last month to see the Kenya shilling trade below the 85 shilling mark to the dollar. This is the fifth time the central bank has reduced its benchmark rate since it began a series of cuts on the lending rate in July last year, when the rate was reduced from 18% to 16.5%. Even though the central bank has spent a better part of 2012 and 2013 slashing the lending rate to single-digit levels, commercial banks in the country are yet to follow suit.
There is something they call the spread, the difference between the interest rate that the bank pays you for your deposit and what they are charging for the loans. It's still very, very wide. We need to keep asking why is that being allowed to go on. Because if they talk about the risk factor, we all know that they are minimizing the risk factor by virtue of the fact that almost every loan worth talking about, the security perfection in this country is as high as it comes.
In spite of the improvement, the committee has warned of possible threats to the macroeconomic stability. The uncertainty in Europe and the country's widening trade deficit might erode the gains made by the shilling and impact negatively on the inflation rate. Denis Otieno, Citizen Business.